Hey TSW Forex, welcome to another episode. This is the second chapter in our course that we have for you guys, the TSW Forex free course. Now let's get straight into it. Okay, so in this chapter we're going to talk about Forex terms. First, we're going to look at what is a pip. We're going to talk about ask price and bid price. What is a spread? We're going to talk about lot sizes. What is leverage? What is margin? How to calculate value per pip? Market volatility. Talk about volume, slippage, market gap, long and short. We're going to talk about the terms long and short. So let's get straight into the first one. What is a pip? A pip is an acronym that stands for percentage in point and is a measure for exchange rate movement. A pip is the smallest movement of increment of price and is the fourth decimal place in a price. The fifth decimal place is called a pipet. A single pip has a standard value of 0.0001. This will be explained further in later chapters. Okay, so this is a graphical representation of Euro USD on the chart, and this is the price that you will normally see. So you will not say, for example, you have the price 1.16541. The fifth decimal place is the pipet, and the fourth decimal place is the pip. In Euro JPY, instead of having 5 decimal places, we have 3 decimal places. And say, for example, we have the price 123.674. The pipet will be the last digit, and the pip will be the second to last digit, as you can see. So the 7 is the pip and the 4 is the pipet. So in essence, a pip is defined as the second to last digit decimal place in a currency pair value. Ask price and bid price. The term bid and ask price is also known as bid and offer. It refers to a two-way price quotation that indicates the best potential price at which a currency pair commodity can be bought and sold at a given point in time. The bid price represents the maximum price that a buyer is willing to pay for a share of stock or other currency pairs or commodity. The ask price, it represents the minimum price that a seller is willing to take for that same currency pair or commodity. What is a spread? Spread is defined as the difference between bid and ask price. It is very important for traders to know what a spread is, and to calculate the spread, you minus the bid price from the ask price. Okay, so looking at this graphical representation, this is Euro USD on the MT4 platform, and we're going to discuss what platforms are in chapter 4. So we can see here the bid price and the ask price, and of course the bid price is the price that that you're buying at. So the highest price on it is the bid price, and that's the price that you're going to buy. And if you look here, you can see buy the market, buy market, which is the current market value. As you can see on the chart here, there's a 1.17559. That's 1.17559. That's what the broker is going to give you for the same Euro USD to buy. But however, if you're selling, they give you at 1.17557. And this the difference between these two prices is what we call the spread. Lot size. In the past, spot forex was only traded in specific amounts called lots, or basically the number of currency units you will buy or sell. Lot is the number of currency units. A standard lot is equal to 100,000 units of a base currency, your account currency, sorry. It means that if you want to trade Euro USD, you will need $100,000. The 3 other sizes are mini, micro, and nano lot sizes that are 10,000, 1,000, and 100 units respectively. What is leverage? Remember, In order to trade with standard lot, it would require $100,000. This is where leverage comes in. Leverage is the ratio at which defines the loan amount that the trader are allowed to use to gain access to large sums of trading capital. Leverage can heighten both profit and losses and should be used wisely. Due to the nature of leverage, the standard leverage is 1 to 100. It means if you want to trade one standard lot of the pair, you would have to deposit $1,000. Your broker will invest the remaining $99,000. So in other words, if you have a 1 to 100 leverage, for example, for every dollar that you have, your spending power is multiplied by 100. So a 1 to 100 leverage is basically saying for every dollar that you have, it has the spending power of $100. Different leverage offered by brokers may vary. Some of these leverages are 1 to 1, 1 to 2, 1 to 3, 1 to 5. Then double digits, we have 1 to 10, 1 to 15, 1 to 20, etc. Triple digits, we have 100, 1 to 100, and go all the way up to 1 to 500. But some brokers go up to all the way to 1 to 1000. What is margin? Margin is mandatory to trade in Forex. A margin can be considered as the minimum collateral or deposit. This margin allows you to effectively take a loan or have access to larger amount of capital. How to calculate the margin per trade? An account leverage ratio is used to determine how much margin will be required. So the overall lot size divided by the leverage amount is equal to the leverage that is required. Example, if you have two lots at a leverage of 400 to 1 or 1 to 400, you have 200,000, because remember one lot is 100,000 units. So two lots is 200,000 units. Divide that by the 400, which is the spending power of $1, and you get $500 margin required. And just to add a little note, margin call is a notification you will receive when there is not enough funds in your trading account to support an open trade. So when your floating losses are greater than the minimum margin required, that's when you will get the margin call. So here we have a graphical representation of standard lots, what is lots, number of units, and how it is represented on the platform, and the value that it has in pips. So we're going to look at pips, lot size, and leverage in general. So a standard lot, which we know is 100,000 units. On the platform that you're using to trade, normally you will see it as volume. So you will put 1.00. That's the quotation that we use for it. So we have our standard lot, gives you 100,000 units of currency, but we type 1.00, and it has a pip value of $10. A mini lot, which is 10,000 units of a currency, on the platform we wouldn't write 10,000, we write 0.1 or 0.1, and it has a pip value of $1. Microlot, 1,000, etc. So calculating pip value. Now that we know what a pip is and what a lot size is, we will now calculate the value per pip. This is crucial in calculating risk reward. And the formula for doing so is the number of pips moved times the value per pip times the lot size used. So say you bought USD, your USD at 1.16500 on a standard lot and closed that trade at 1.7500. Therefore, the number of pips is 100 pips, because remember, this is a pipet. We're not going to focus on that. The last decimal place is a pipet. So we have 1.1 1.1750 minus 1.1650, and that gives us 100 pips. So in essence, the amount of money that would have made on that trade is, we have the 100 pips, which is the number of pips moved, times the value per pip, and of course we know the value per pip for on a standard lot is what? $10. So we have that $10 multiplied by the lot size used, which is the standard lot, which is equal to 1,000. So if we had a 2 standard lot used in this instance, we would have had 2 here, 3 standard, 3 here, etc. So say you bought your USD. We're going to do it now in a different way. We're going to calculate it in a different way. You had your USD bought at 1.65000. So we're still calculating pip value. So say you bought your USD at 1.16500 on a standard lot. Of course, a standard lot is 1.00 on the platform, but we know that it's 100,000 units, and you close the trade at 1.7500. That is saying that you bought 100,000 units of your USD at a price of, remember the current price that they have. So the 1.6500 is the price that you bought at. So we're multiplying 100,000 units times the price when you bought it, and we got 116,500. Now, when the price went to 1.17500, that same 100,000 units is now worth 117,500. So when you close that trade, the difference between the two prices is what gives you the profit. So when you bought it, it had a value of 116,500, and when you close the trade, it had a value of 117,500, and the difference between that is $1,000. So that is how we calculate the value per pip. What is market volatility? As stated already, Forex is the most liquid market in the world. It is a measure of how drastic a market price changes. So a highly volatile market will see its price move more quickly and in larger increments. A market with lower volatility will see prices change more gradually over time. A market's liquidity has a big impact on how volatile the market prices are. Although Forex is very liquid, it is affected by so many factors, which include political, economic, and social events. Means that there is a lot of things that can cause volatility. And of course, we'll talk about fundamental analysis later in the course. Volatility is seen as a negative for two main reasons: uncertainty and high risk. So most traders try to avoid the market whenever it has high volatility, which is normally what happens when there is a news or an event taking place. So in a sense, it can be your friend or your foe. What is volume? Volume in Forex has two meanings. It means the amount of money in the market at any given time, and it also is used as a synonym for a lot by some brokers. So whenever you're on a trading platform and you're taking a trade, you may see volume. Don't get scared or confused. It's just asking what lot size do you want to trade, the pair or the currency or the commodity or whatever CFD. What is slippage? Occasionally during trading, the trader will notice a slight difference between the price that they expect the execution price to be and the price that the trade is executed. So we're going to talk about types of orders. That is in phase 2. Slippage is the difference between the expected price of a trade and the price at which the trade actually is executed. So for example, you wanted to buy your USD at 1.6500 and the market was in an uptrend, so you had a buy stop order, and instead it was executed at 1.16500, it was executed at 1.17 That's a big difference. So that is what the slippage means. The price that you wanted the price to execute at is not the price that you get. Market gaps can cause slippage, which may affect stop and limit orders, which we're going to discuss, of course, in phase 2. Meaning they will be executed at a different price from the requested. When this happens, it is known as slippage. It's a common thing to experience as a trader, and it can work either positively or negatively. The main reason for this is market volatility and execution speed. So remember, volatility has to do with how fast the price moves. So if it's moving very fast, the broker to which you place the trade with, they execute that trade very slowly. By the time the price is supposed to reach a different point, it's going to use the closest price to the one that you place their trade to be. So that is what slippage is. Market gap. Market gap. So market gap occurs when an asset or CFD closes at a specific price, and the immediate opening price in a given time frame has a gap very noticeable between them. Usually price continues from the same point in a given time frame. Market gap usually occurs over the weekend. So what happening is between the closing hours and the opening hours of trading, whenever trading is allowed. So between Friday and Sunday, anything can happen between Friday and Sunday over the weekend. So you might have news events or world events or geographic events or geopolitical events taking place over the weekend, and that can shift economic balance and create a gap in the market price, and that can be against you or with you. So most traders are advised to close their trades before the weekend. So this is what market gap is. And finally, the term long and short. So in Forex and stock trading, the term long refers to a trader or investor buying an asset or CFD. And the term short refers to selling an asset or CFD. And this is the end of TSW Forex Chapter 2. We talk about terms, and stay tuned for the Chapter 3. We're going to drop some more content for you guys. I hope that you guys found this very educational, and I hope that you guys find this very entertaining as well. Remember to subscribe, like the video, share, and comment. We'd like to hear your voice, hear whatever your thoughts you may have, ideas that you think that we can do to make this channel grow. And for the subscribers, thank you for being with us. We appreciate you. And for those who are new, looking forward for you guys to being in this community as we plan to build our community. Thank you for your support again, and stay tuned.